Welcome to Money Manager. In the studio with me in Cape Town is Victoria Reuvers from Morningstar. We're talking about the Nedgroup Investments Global Equity Feeder Fund. Just looking at this fund, Victoria, it does well. It beats the benchmark, which is what, the MSCI?
Yes, it is. It's done exceptionally well. It boasts one of the best track records in its sector. Nedgroup, as you know, do not employ their own asset managers. They have a best-of-breed philosophy,
Yes.
which means that they appoint specialists in their areas of expertise. In this case, they appointed Veritas Asset Management in 2010 to take over management of the Global Equity Fund.
So it's just they appoint just one manager? Have they had multiple managers in the past?
On the Global Equity Fund, they have had a few managers. Veritas have been managing it since 2010 and have done an excellent job.
Yeah, I suppose since 2010 we've been in a bull market, so I wonder what might happen to Veritas or whoever they appoint in what might be either a sideways or a bear market. And you've been tracking this fund for how long, since inception?
Yes, pretty much. So interesting that you mentioned what happened prior to 2010. Veritas is a business, they're based in the UK. Morningstar conduct analyst research on them, and they actually awarded Veritas the fund that replicates the Nedgroup Global Equity Fund is called the Veritas Global Focus Fund, and it was awarded a Morningstar Gold analyst rating, which means that we have a very high level of conviction in the fund outperforming going forward. And we think one of the standout qualities is really the management of the fund. So although they didn't manage the Nedgroup Global Equity Fund, they did manage money through the pullback of 2008.
Every time I speak to somebody on Money Manager, it's always, well, it's not always, but a majority of people have got their 25% that they're allowed in a Reg 28 fund, for example. It's all about diversification, but it's all about, if I could have more than 25%, I would have more than 25%. Some people will say it will be 35, other people would say it would be as high as 50. How do local managers, this is an aside, how do local managers managing global equity do against global managers managing global equity? Are we up there with them?
We really have stacked up very well. They manage money very differently to your traditional global equity manager. So in fact, Veritas is more similar to the local managers in the way they manage money rather than global managers. So for example, what you find globally is managers are much more specialist. So you would find a US small cap fund or a European equity fund. A general global equity fund of this nature tends to have a lot more shares, and they're very benchmark cognizant.
Yes.
A fund like the Nedgroup Global Equity Fund, and as well as our local managers, have far more concentrated portfolios. So we've been giving it a lot of thought to say, why have our local managers done so well in managing global mandates? And for some time now, they've had to develop that capability. If you think back 10 years, firstly, we had much tighter exchange controls, we had our domestic market looking attractive, and that 25% component was significantly smaller, so carried less weight at a portfolio level. And with the relaxation in exchange controls, the increase to 25%, and I guess our markets looking expensive, they've had to develop that capability. And you've seen them apply some of the framework they use on the domestic side to screen stocks, and at times they will, start with familiar industries, for example, associated industries. If they know SAB well, they can transport that to the other brewers. They also look for sister companies, but they've done a very good job.
Yes, indeed. I mean, if you have a look at the JSE and look at the number of tradable shares for big funds, it's very, very small compared to the thousands and thousands and thousands on the FTSE, any of the FTSE indexes or any of the indexes in the United States of America. So what we do, I mean, a local manager must have a look at the international choice, the international universe, and say, this is very daunting, let me stick to what I know. Maybe that's part of the reason.
Well, they do generally use screening frameworks looking at different metrics to narrow down their universe. But if you think of a business like Investec, they do have a true global capability sitting in their London office. If you think of Coronation, they started off with their emerging market capability, which was, they had a frame of reference being an emerging market ourselves, and now they're developing their global equity capability. But it takes a long time to build up a deep knowledge of that global universe, and you would generally start with what you know or where you have a level of skills.
Maybe we're more enthusiastic, maybe we're cleverer than these people overseas, maybe we have a better philosophy, maybe we've learnt over a couple of decades of relatively tough times because there's always some politics in the background. Maybe that's what it is. Tell me about the fund now. I'm looking at the top 10 holdings. I know it's not your... Now let's look at the portfolio structure first of all. US equity, 48%. That's quite big.
That is quite big, and the way this fund is managed is they use a thematic framework to look for businesses that will benefit from structural changes in the industry. They look for tailwinds and headwinds at an economic level. Two themes that they've employed in the fund for a while. The one is what they'd like to term 2020 industry winners, and these will be businesses that are of huge importance in 2020. So if we think of inevitable trends such as the explosion of data,
yes,
such as increasing regulation, such as online transactions, these are businesses that may not have the strong earnings growth that comes through right now, but they believe will be dominant in 2020. And the second theme is scarcity and supply constraints. So for example, they own a satellite company, Lockheed Martin, where they believe huge costs, large barriers to entry to get the satellites into the sky. But
the Warren Buffett approach, of course.
Yes.
Sort of.
So they do apply a quality overlay. They look for good management, a moat, free cash flow. So yes, similar in that regard. But I think one of the sort of standout characteristics really of this fund is that as an equity fund, it has an absolute return benchmark, which is quite rare. Although its stated benchmark is the MSCI, they only invest in companies where they believe they can generate 15% absolute positive returns per annum over the next 3 to 5 years. So although long-term investors, they're not looking for 10 or 15-year returns.
I wonder if they'll change their tune or change their geographical composition if the United States does raise interest rates. We've just recently had the Deputy Chairman of the US Federal Reserve saying that inflation probably will start picking up and therefore they want to get ahead of the curve. I mean, this is reading between the lines. But I suppose the industries that you've just spoken about, the data and also the industries with this great barrier to entry almost a cartel, like a monopolistic qualities, won't be affected. They go then after that, I mean, the next big one is 20%, so really a concentration in North America and then down to Europe. Again, I wonder if that might change, should the interest rate scenario change from one geography to the other.
If you think of the global investable universe of 6,000 shares, they only have between 25 to 40 shares in the portfolio. So it's a very concentrated portfolio with the top 10 comprising 40%, which means that the geographic allocation is purely a function of their bottom-up stock picking. And they don't have no medium conviction shares that they own, only high conviction shares. So I think the geographic dynamic may not change too dramatically. That's really just a byproduct of their valuation process.
Top 10 holdings now. Let's go from there. Actually, let me let you know what else that they have in this portfolio structure. UK equity is only 10%. Foreign cash is 14%. That's quite high.
It is, and as mentioned, they look for businesses that can generate 15% per annum. If they cannot find those businesses, they will default to cash. So 15% is very high. The maximum they can hold is 25%. And I think the Veritas Global Focus Fund, so the mirror of the sub-advised fund, had close to its maximum at the end of 2007. So they have been there before, and it's really a function of what they find in their investable universe. They won't own shares just for the sake of owning them. No.
Asian equity 8%. Emerging markets equity, this is quite startling, 1%.
Thumbs down for South Africa. Yeah, it's one company, it's MTN actually, that they own in the entire emerging market universe. And talk about trends, 2020 trends. They have identified cellular phones and the transmission of data and just the network that comes with that. And MTN, they believe, is the one business that we may see it in the South African universe. It's sometimes expensive, sometimes cheap, but they believe will be a dependable compounder in the future.
This is very good. It's only 2015 and they're already looking 5 years forward. Things do change, of course, but it just shows you that they, and I suppose they can focus on these sort of things if they've only got 25 to 40 shares in their portfolio at any one time. They're not having people running around, flying around, looking at 100 companies. This is this is the sort of approach I would employ as well, less work. The companies you've highlighted in the top 10 holdings, Microsoft, United Health Group, London Stock Exchange Group. Let's start with the London Stock Exchange Group if you're comfortable talking about this. It's like the JSE Limited. Last week we had one day on the JSE where we had 33.6 billion in value traded, and I thought to myself, well, the market was down on this day, all over the place on this day, but one company that just sits there and takes all this is the JSE Limited. Same with the LSE.
Yes, stock market or indices benefit through volatility and through positive returns. So they do as well in bad markets as they do in good markets, as you say. Negative markets increase trading, increase revenue for stock exchanges. That really plays to their theme of sort of the explosion of data and also having barriers to entry if you are the holder of that data and of that market.
Looking at Microsoft, and you're talking about data, and you're talking about companies that haven't yet translated their technology into monetization. But Microsoft, of course, is reinventing itself all the time. It was the dog for a long time, old school IT, but now is becoming a firm favourite.
They also have barriers to entry. For example, everybody has Office on their computers. To change that at a business level is extremely, and that is a very large barrier to entry. They have a lot of cash on their balance sheet. Relative to the index, they have quite a substantial overweight in Microsoft, and that will feed through to the US portion of their portfolio. But as mentioned, Microsoft is not solely dependent on US growth to do well.
Who should be looking at this sort of fund, the Nedgroup Investments Global Equity Feeder Fund? What type of investors should be looking? I mean, given these performance periods, performance figures rather, over 1 year, 20.4% with a benchmark of 16.3%. They're always beating. I mean, if you look at 5 years per annum, 23.3%, MSCI delivered 20.6%. I mean, these sound like small increments, but it's quite significant if you take the percentage of the percentage, if you see what I mean.
Yes, there are not many funds that have beaten, well, global funds that have beaten the MSCI World Index over the last 5 years. In fact, the flows into passive funds in the States has been exponential. So for a manager to have delivered that performance is really good. There are two entry points for South African investors who want to invest in global funds. The first is through the RAND version, the feeder fund version, which is the performance numbers that you're quoting. Do bear in mind there's a lot of currency depreciation in that number. And then the second entry point is through the US dollar share class, which investors can buy. This is really, it is an equity fund, although it's got 15% in cash, it's for long-term investors. Yes. So the question of currency, what about now? If you're investing for the long term, share prices may move, but at the end of the day, you're buying businesses. So you want to make sure that you are buying businesses, you're not buying an index, that you're buying businesses with sustainable cash flows, good barriers to entry, and that are going to be making money in the next decade.
Victoria, we'll leave it there, but thanks very much for popping in this evening.
Pleasure.
It's Victoria Reuvers from Morningstar. We've been speaking about the Nedgroup Investments Global Equity Feeder Fund, and that's it for Money Management.